Just to give you a quick outline of what we want to cover today. First, we'll give you a quick recap of what happened in the year 2021 in the markets, specifically in FX markets. This is the year in which two things happened. First of all, the dollar rallied, as we're aware, and inflation became the major concern, the major macroeconomic concern for the first time in many decades. In 2022, we expect inflation to remain front and center. We expect the main driver for the markets to be the extent and the speed with which central banks respond to this inflation overshoot. The outlook for the economy is generally good. Inflation in this case, unlike in the 70s, for instance, so far is accompanied with strong growth, both in demand and investment. And the restrictions from the Omicron variant seem to be mostly behind us, and we think it's unlikely that we'll see another round of lockdowns like we did in the year 2020-2022. However, a potential source of trouble, tail risk, is whether the bond market, fixed income markets in general, sell off aggressively, given the fact that rates in most of G10 countries are still way below where inflation is, which is historically has been an exception rather than the rule. Finally, we will cover the additional variants of vaccine rollout with a specific focus on emerging market currencies, which we expect to shine in 2022 as the vaccine rollout accelerates in emerging markets, and given that the central banks of those emerging markets are ahead of those in the G10 in responding to the inflation overshoot. So after that, we'll have a Q&A session, and with that, I will hand over the baton to Matthew, who will give us a recap of what happened in 2021.
Yes, thank you very much, Enrique, and welcome everyone to our webinar today. Thank you all very much for joining. 2021 was an interesting one again in the foreign exchange market. It started off much as 2020 ended, with focus very much on the COVID pandemic, certainly throughout the first half of 2021. The main driver of currencies, at least the main driver of the major currencies, was the speed at which nations around the world were able to roll out the various vaccines to their populations. Sterling and the Canadian dollar largely outperformed due to the rapid vaccine rollouts there, while the Australian and New Zealand dollar were among the worst performers as the vaccine rollout in those two countries lagged well behind. However, the second half of last year, attention very much shifted to the more conventional drivers of currencies, those being macroeconomics and monetary policy. Particularly since mid-2021, investors have been fixated with this overshoot in inflation that we've witnessed around the world in the major and emerging market countries. In most instances now, inflation is well above central bank targets. In fact, 7 of the 10 G10 nations now have inflation that is exceeding the upper band of their target range. And central bankers are coming around to the view, at least in the last couple of months or so, most central bankers are coming around to this view that the drivers of price pressures are now no longer seen as temporary or transitory. They're acknowledging that price pressures are here to stay, and that higher interest rates and a removal in the accommodative policies is the way forward. We've already seen many central banks in the G10 and among emerging markets either unwind or remove their quantitative easing programs or start raising interest rates. This was led by emerging markets, like central banks in Brazil and Russia, hiked rates at a very aggressive pace last year. We've already started seeing some of the major central banks in the G10 follow suit. Norges Bank, Reserve Bank of New Zealand, Bank of England, and that's expected to be the theme going forward in the next few months. The pace and the timing of interest rate hikes from these major central banks. As Enrique mentioned, also the main theme among currencies was this strength that we witnessed in the US dollar. The dollar rose against all but one of the G10 currencies, and most, not all, but most emerging market currencies last year. The dollar index ended the year around about 7% higher than where it began it, while against emerging market currencies, at least the JP Morgan emerging market currency was down around about 10%. Other emerging market indices held up relatively better, but we did see broad sell-off in a host of emerging market currencies, some in excess of 10%, the likes of Colombian, Chilean peso, and the Turkish lira, which suffered from quite extraordinary sell-off by any account. It was down more than 40% for the year against the US dollar, due to concerns about the monetary policy stance adopted by Turkey's central bank. As I mentioned, though, there were a few exceptions. We highlight in particular the Chinese yuan, which we think has transitioned more into a major currency than an emerging market one, and has held up relatively well, and very well, in fact, in the face of this US dollar strength. We do think, however, that the rally that we have seen in the dollar so far has been perhaps slightly excessive. The move that we did see was driven in large part due to heightened bets in favour of Federal Reserve interest rate hikes. The market's now pricing in 4 rate hikes from the Fed over the course of this year. So market pricing is relatively elevated. The dollar has rallied quite aggressively, as we can see, against most currencies. We think there may perhaps be a bit of a scope for a bit of downside in the dollar, given these very saturated market bets. But that was 2021. What can we expect for 2022 in the markets? Well, we've highlighted here 5 key things that we will be looking out for in the next few months, and the 5 main things that we think will drive currencies this year. The first one, and the main one that we've been talking about already, and that's this inflation overshoot that we're witnessing around the world in developed and developing nations. We think that the extent and magnitude of this inflation overshoot will be key. We've already seen some major central banks retire the word transitory. We expect others to follow suit in the not too distant future. And that leads into number 2, and that is, how will central banks respond to this inflation overshoot? As I mentioned, both the pace and timing of interest rate hikes are going to be key. We think that that'll be the main driving force as to which currencies either under or outperform. The key theme, perhaps, that we're looking at is this divergence we've witnessed between the Federal Reserve, which has been very hawkish, and the ECB, which has been very dovish. We question as to how long the European Central Bank can continue to lag behind its major peers in raising interest rates, as we'll get onto in a little bit. We think that they can't wait as long as the market expects them to before they start raising interest rates. Also, a key topic that we've been focusing on the first sort of 2 or 3 weeks of this year has been what's going on in the bond markets. We've seen a sharp sell-off in bonds around the world. Bond yields have risen aggressively. That presents somewhat of a risk to outlook, and we'll talk about that in more detail later on. And then, of course, as this is a 2022 outlook, it'd be remiss of us to not talk about the COVID-19 pandemic, which continues to remain a consideration for investors, albeit we think that the impact on currencies from the pandemic will be increasingly less than this year than it has been in the past couple of years, but still a consideration, and still potentially we think could impact currency markets. And now, with that out of the way, we move on to our first topic, which is inflation overshoot. And I'm going to pass back over to Enrique, who's going to cover the next few slides.
Thank you, Matthew. Well, inflation. That's all that we're seeing, not only in the financial press, but increasingly in the regular press as well. I like to remind, I like to say that this has been our position throughout 2021. We thought that inflation was structural, at least if not structural, it's definitely not transitory. And I think that the recent data has borne out our position rather well. Inflation out of the G10 economies continues to surprise to the upside. Economists and central bank forecasters continue to revise upward their projections for inflation, the forecast for inflation, but the actual data tends to come out even higher. As seen by this very interesting graph of the inflation surprise index, which measures not just not inflation, but the extent to which inflation data comes above economists' predictions for inflation. And so far, there's no let up in this index. So before we see a peak in inflation, we definitely need to, I think we need to see this, this graph come back closer to zero, which tells me that we're still a long way away before inflation peaks. Central banks are coming around to the view that we had that the spike in prices is not transitory. They also continue to raise inflation overcasts. They've gone from the confidence with which they stated that inflation was going to be transitory and probably come back to normal at some point in 2022 is gone. And it's being replaced by comments and statements regarding the enormous uncertainty over the inflation outlook. We think that above target inflation is here to stay in 2022, frankly 2023 as well. Possibly there will be some pullback over 2022, but I don't think we're going to come back to the theoretical targets of most G10 central banks, which are around 2%. I think that we're going to remain above that for the foreseeable future. So we go to the next slide. In particular, the US inflation rate has been leading this round higher in inflations. Generally, new economic trends make themselves noticeable in the US before the rest of the world because the US has a very flexible economy that responds very quickly to changing circumstances. Headline inflation is now 7%, which is the fastest since the bad old days of 1982. While initially the inflation was driven by goods, given the demand for goods during the lockdowns in the pandemic, and also energy. Clearly, over the last few months, inflation has been spreading, and core inflation that excludes the volatile items has also increased to a 30-year high, well above 5%. In the Fed's preferred inflation measure, which is even more restrictive, is also at 4.7%. We need to remember here that the Fed inflation target is 2%, and that the entire structure of interest rates in the US seems to be, or so far has been, anchored by the idea that we're going to come back to 2% quite quickly. This is not happening, and that brings a lot of uncertainty over what's going to happen to the bond market. Again, these are by now very broad price pressures. And almost any inflation index that you care to look at has clearly spiked during 2021, and inflation momentum remains quite strong. The core inflation over 3 months, which is, if you take the last 3 months of core inflation, which is probably the strongest leading indicator for future inflation, it's a nearly 7% annualized in the 3 months ended in December. Go to the next slide. The euro area prices, the price spike in the euro area has lagged somewhat, as it often does, but we've been lately seeing clear signs that the uptrend is clearly in place and that is catching up quickly to the United States. Headline inflation rate is now 5% in December. It's true that it's 7% in the US. Core inflation is at 2.6%. Now, these are not directly comparable indices. There are some differences in the way the indices are computed in the US and the Eurozone. If you adjust for the difference in which the indices are computed, half of this gap between headline and core across the Atlantic, between the US levels and Eurozone levels, half that gap disappears. So again, with a little bit of a lag, Eurozone inflation is catching up to the rest of the world. The higher prices are partly due to the energy crisis. Demand for energy has surged as lockdown eased, and the Eurozone has some specific energy dependence issues, in that it's almost entirely an importer of fossil fuels, and that is much more advanced in the green transition than the rest of the world, which unfortunately makes it less resilient to the spike in gas prices that we have seen worldwide. Here we have seen a divergence between the European Central Bank and the Federal Reserve. The Federal Reserve has clearly done an 180-degree turn in inflation. It no longer expects it to be transitory. Whereas the European Central Bank, at least that faction led by President Lagarde, continues to perceive inflation overshoot as transitory, continues to insist that it does not need to deal with it by raising hikes until 2023. We expect that view soon to change. We'll go into more detail. But I will say that today we have yet another inflation data out of Germany, producer price index, which is the traditionally leading indicator to consumer prices. And we had another massive upward surprise to 25% year on year, which is an all-time record. Again, there are some transitory elements to this inflation spike. Energy prices in particular are very high, but even ex-energy producer prices in Germany are rising at almost 9% if you look at the last 3 months. Again, we think that the ECB is incorrect in characterizing this inflation as transitory, and we expect that to soon change. We go to the next slide. In the G10 countries are all experiencing generalized inflation, with a couple of significant exceptions. The usual in Japan and Switzerland. Even there, we have seen an upward push in inflation back towards zero, but it's clearly that not every G10 country is being affected by the surge in inflation. The US is leading. Most of the rest of the G10 is following, and Japan and Switzerland, as often is the case, still present negative inflation. But everywhere the trend for inflation is up, and there is no sign that price pressures have peaked in any of these economic areas. Go to the next slide. Now, what's behind higher inflation? That's the argument that, I mean, now that we have gotten over the argument whether inflation is here to stay, it is. The next discussion is what is causing the spike in inflation, because the central bank response that would be appropriate to deal with it will depend very much on what the cost for it is. Now, it's not controversial to list the potential causes as supply chain disruptions, as the lockdowns diverted a lot of the demand that traditionally goes into services, restaurants, traveling, tourism, etc., into buying goods instead. The supply chains were perhaps not ready to handle the sudden surge in demand for goods, and there's been snarls in areas such as manufacturing, the delivery of key elements in the production process like chips, bottlenecks in the different ports, etc. Then, as lockdowns ease, this pent-up demand, people have been prevented from going to restaurants, traveling, buying things, etc. This demand, this pent-up demand was released suddenly as lockdowns eased, and that added to the problem. Higher energy and commodity prices. In particular, in energy, we have a situation in which, partly because of climate change concerns, there has been a lag in the response of exploration for new oil fields and new sources for carbon fields to higher prices. This is the first time where higher energy prices have not been accompanied by a surge in exploration for additional oil sources, partly driven by climate change concerns. This propelled the price of oil in particular, and also natural gas, higher than it would have otherwise done. And finally, number 4, and in my view the most important one, is the fact that fiscal and monetary policies continue to be extremely stimulative. We have fiscal deficits, government spending far more money than they collect in taxes, 12% of GDP in 2021 in the US, 8% in the Eurozone, similar levels of deficits in most of the G10 countries. These are enormous fiscal deficits in economies that have pretty much recovered, where unemployment rates have gone down to the levels they were below the pandemic, which are pretty close to full employment. So you're releasing this additional fiscal stimulus on economies that are at or pretty close to full employment. On top of that, we have extremely stimulative monetary policies. Interest rates are way below inflation in almost every G10 country, definitely the main ones, US and the Eurozone. We have real rates at -5%, -7% if we use current inflation. This is a very explosive cocktail of to boost both demand and investment at a time where the supply side of the economy cannot handle it. The result is higher inflation. We go to the next slide. In addition to this immediate causes for inflation, we do believe that there's been some structural factors that are going to continue to drive inflation higher over the next few years. First of all, there's no political opposition to inflationary policy, right? After so many decades of inflation being modest, not volatile and under control, because a level of complacency has developed about the problem of inflation. Central banks are much slower to raise hikes when inflationary pressures appear than they used to be. There's little concern with fiscal deficits, and that means that the political will to fight inflation is going to be lacking over the next few years. We have large structural fiscal deficits over the G10. Most G10 countries and most countries in the Eurozone have a tendency to have a deficit over the business cycle. The political pressure to keep monetary policy extremely accommodative, both through negative rates and through monetization of sovereign debt, is very high, as we have seen in the European Central Bank, that is trying to do what it can to delay monetary adjustment. We have the trend that did so much to lower the price of goods structurally, the trend towards offshoring, producing goods where it was cheaper to produce them, just-in-time inventories, etc. That trend has probably come to an end, not just because of the pandemic concerns, but because of prior geopolitical conflict with China. And there's now a clear political pressure towards reshoring, which will bring some benefits in terms of reliability of the supply chains, but also will bring higher costs and less efficiency overall. Also, a big part of the deflationary pressures, the tendency towards lower inflation that was on the last few decades, had to do with offshoring to the emerging market countries, like primarily China, but not exclusively, and taking advantage of the low wages. The rapid increase in wages in most of those countries of the last decade or so means that the wage gap has diminished dramatically, and there are much fewer gains in efficiency to be had from exploiting that gap. Efforts to mitigate climate change are increasingly inevitable, and especially in the field of energy, will result in less production and higher costs than we would otherwise have. Whatever the benefits of fighting climate change, which are undeniable, it does mean additional inflationary pressures, particularly in the area of inflation. And the NIMBYism in many G10 countries, which is, the difficulty in building housing and infrastructure generally in G10 countries because of political opposition. So these are 7, I think, very important long-term trends that mean that inflation is here to stay. Even after the current temporary factors disappear, I think we're going to be left with structural inflation levels that are way above the theoretical targets of most G10 central banks. So much for inflation. Now we'll talk about the response by the central banks and the different responses to them, which is, I think, what will drive FX markets and the performance of the different currencies over the 2022. In December, the Federal Reserve increased the pace at which it curtails the purchase of government debt. The pace of net purchases will be increased. The pace, not of net purchases, but the pace at which the monthly amount of purchases is reduced will go from 15 to 30. What this means is that there will be no further purchases of government debt, of US government debt and mortgage securities by the end of March. At that December meeting, the members of the committee significantly revised higher their interest rate projections. 12 out of 18 expect 3 rate hikes versus only 9 that expected just 1 hike in September. Even after the latest declarations of Federal Reserve officials and the latest moves in markets, it seems that this is too conservative. The market is now pricing in 4 full hikes and a slight potential for both a 50 basis point hike in March and 5 basis points, 5 hikes during 2022. The communications of the meeting were also very hawkish. The word transitory was officially retired. And the Fed highlighted that inflation becoming more persistent is now its main concern. This communication has been again reinforced by increasingly hawkish statements and speeches by Federal Reserve officials. We go to the next one. It is clear that the Fed will hike in March. There's, like I said, the markets are even predicting a slight chance of a 50 basis point hike rather than 25 basis points. Fed fund futures are now pricing also 4 hikes, actually a little bit more than 4 hikes by year end. And our view is that the markets, for the first time in many years, or at least many months, are largely correct. The Fed will hike in March, 25 basis point hike, and we'll follow this up with a hike per quarter to lift the rate up to 1% in 2022. In terms of the impact of the FX, expectations have moved so much for the Fed that it's difficult, even for me, who are, I'm probably one of the most, one of the strategies out there that is most concerned with inflation, especially with the medium and the long term. It's hard for me to see the Fed exceeding these very aggressive markets expectations. And this may limit the US dollar, the upside of the US dollar, especially if, as we expect, the European Central Bank accepts the reality that inflation is not transitory and gets ready to hike later in 2022. And with this, I think I'll hand over the baton back to Matthew.
Yes, thank you very much, Enrique. We go from one extreme to another now, from the Federal Reserve that, as Enrique has mentioned, has been one of the more hawkish central banks, certainly in the last few months, in the G10, to the European Central Bank, which has been among the most dovish. President of the ECB, Christine Lagarde, has continued to insist that this recent inflation overshoot that we've seen in the Eurozone is of a transitory or temporary nature. She's also continued to push back on market pricing for interest rate hikes in 2022. And that's a large reason as to why we've seen this underperformance in the euro against most of its peers in the last few months. We did, however, get a hawkish tilt from the ECB at the December meeting. The ECB formally announced that the Pandemic Emergency Purchase Programme, the PEPP, will be wound down to 0 by the end of March in a removal and a move away from the emergency policy settings during the pandemic period. According to Lagarde, in order to avoid what she called a brutal transition, the ECB will temporarily increase purchases under the traditional APP, Asset Purchase Programme. This will be increased from 20 billion euros a month to 40 billion from Q2, from April. This will then be wound down to 30 billion in the third quarter and then back down to 20 billion in October. This was seen as a moderately hawkish announcement, given that the market didn't necessarily expect the ECB to announce its plans beyond the second half of this year, albeit the actual reaction in the euro was limited, which spent, certainly against the dollar, spent much of December trading within a relatively narrow range. The ECB was also upgraded its view on inflation, particularly for 2022. The forecast for this year was revised up very sharply from the September projections, 1.7% to 3.2%, so almost doubling in its 2022 inflation view, which is a very significant revision by any standards. Lagarde has not yet, as I mentioned, formally announced that this, or retiring in this word, transitory, unlike Jerome Powell. But we view her press conference in December as a mixed to hawkish assessment of conditions. The ECB continues to see an economic recovery in the Eurozone and now sees risks as broadly balanced. But what can we expect from the ECB in 2022? Well, as we've been mentioning, expectations for hikes from the ECB at the moment are very low, as we can see from the charts. This represents a number of 10 basis point hikes that are priced in by the market over the course of this year. So we can see that a 10 basis point move is barely priced in by the end of the October meeting, and then slightly higher chance by November. But this is considerably less than what we're seeing pretty much everywhere else, certainly among the G10 nations. As mentioned, Lagarde has continued to insist on this view that inflation is of a transitory nature, but we think it's only a matter of time before the bank moves away from this view. Indeed, we're already seeing signs of dissent among governing council members. The Vice President de Guindos spoke last week and warned that inflation may not be as transitory as previously believed. The December communications, as we said, were slightly on the hawkish side as well, and suggested that the ECB was not unanimous on its reinvestment plans. And indeed, we had the release of the ECB meeting accounts earlier this afternoon, which confirmed that this was not unanimous, and also a number of members now appear concerned over overshooting inflation over the longer term. We think that this growing size of dissent and hawkishness will become increasingly more apparent in the next few weeks, particularly if inflation in the bloc continues to surprise to the upside. And as such, we think that the ECB will not be able to wait until 2023 to start raising interest rates. We think that actually market pricing for hikes in the Eurozone this year is too low. We think it's a little bit of an underestimation in our view. Unlike the Federal Reserve, we think there's now actually quite a large gap between reality and market pricing for ECB hikes. Whereas for the Fed, we think it's very narrow. So that could potentially present somewhat of an upside, we think, to the euro should the ECB start raising interest rates in 2022. But we are interested to hear your view, and I will try and launch a poll. Hopefully you can all see this on your screen. If not, there is a tab at the top which you should be able to access the poll that I've just started. We have two questions under the poll. The first one concerns the European Central Bank. So we're interested to know your view as to whether you think the ECB will raise interest rates as we do before the end of the year. The second question concerns more the rest of our presentation. I see there's a lot of responses so far, which is great. But our question is, what do you think the main risk for the global economy or the global economic outlook is in 2022? So we have COVID-19, the ongoing supply chain bottlenecks, soaring inflation and geopolitical tensions. And there's a lot of responses already, so that's great. And we'll revisit that slightly later on in the presentation to see the results. Moving on now, and we're going to talk about the biggest surprise among the G3 central bank meetings in December, and that came from the Bank of England. The Bank of England unexpectedly voted in favour of raising interest rates by 15 basis points to 0.25% last month. Communications actually have been very muddled from the Bank of England in the past few months. Prior to the November meeting, Governor Andrew Bailey seemingly indicated that an imminent hike was on the way, only to vote in favour of no change in November. And then prior to the December meeting, we had some very dovish comments from a handful of MPC members, including some of the more hawkish ones that were concerned about the risk posed by Omicron. Many actually said that it was too soon to even think about raising interest rates, only for the Bank of England to vote 8-1 in favour of immediate hike. And one of the more dovish members, Tenrio, was the only member to vote in favour of no change. And this caught markets completely off guard, particularly given the dovish comments prior to the meeting, the uncertainty surrounding Omicron. And for us, I think there's probably this near unanimous vote. It highlights two things. The first thing it does highlight is the Bank of England is not overly concerned, is overly concerned with inflation, is more concerned than we had anticipated prior to the December meeting. Inflation is now expected to peak at 6% in April this year, although data out earlier this week showed that inflation surprised to the upside again in December. We would not be surprised if this projection is revised even higher in the coming few weeks and months. The second thing that it shows to us is that the Bank of England is not overly concerned with the impact of Omicron on the UK economy. And indeed, the weeks since the meeting, we've had more news on the variant, of course. It looks likely to have a relatively minor impact on the UK economy. Restrictions that we have seen reimposed have been relatively minor. So actually, we think this paves the way for a pretty aggressive pace of hikes from the Bank of England this year. We expect another move in February, and we think that the Bank of England should follow that up with at least one hike a quarter during the remainder of 2022. And that provides a good rationale for our view that the sterling should, we think, remain relatively well supported against most of its peers during the remainder of this year. But what about the rest of the G10? Well, we think that we're going to see a similar story among most of these major economic areas, most of which we expect to hike rates at a pretty aggressive pace. We've already seen a couple of rate hikes, each from central banks in Norway, Norges Bank, and the Reserve Bank of New Zealand, the second half of 2021. Norway looks on course to raise rates perhaps on as many as 3 occasions this year, while New Zealand, the Reserve Bank of New Zealand, it looks set to be the most active this year, and the market's pricing in a very aggressive hike cycle there. Similarly, the Bank of Canada has been very hawkish of late. It ended its QE program in October and now looks on course to raise rates on multiple occasions this year. And in fact, I think the market is pricing in around about 5 or 6 hikes, 25 basis point moves from the Bank of Canada before the end of this year. The RBA has been an interesting one. The Reserve Bank of Australia has repeatedly pushed back on calls for a 2022 hike, but we think it's inevitable that they will change their tune very shortly in the next couple of meetings. And we expect, again, multiple rate hikes from the Reserve Bank of Australia. And then we have the other end of the spectrum. We have a handful of central banks that are adopting a much more cautious approach. The Riksbank in Sweden, Swiss National Bank in Switzerland in particular, are unlikely to follow suit with the rest of their peers, and that could potentially, we think, present somewhat of a downside risk to the currencies there. And then we have on the far extreme of the scale, the Bank of Japan, which has made it clear that it doesn't expect to raise interest rates anytime soon. And actually, as you can see from the chart, the market is actually not pricing any chance of a rate hike in Japan this year. So that could, we think, potentially provide some sort of a downside risk to these currencies, while those that are raising rates or set to raise rates at an aggressive pace, we think should be relatively well supported. But what about emerging markets? I'm going to hand over now to Roman, who's going to talk you through what policy moves we've seen among emerging market currencies and countries.
Thank you, Matthew. So emerging market countries have been very proactive in tightening monetary policy. They have been the first one to do so in 2021. Early in the year, we started hearing some jitters that the countries might start raising interest rates, and this was followed up with action that has been significantly stronger than could be initially expected. There were a number of central banks that have raised rates by a few hundred basis points. The ones that have been the front runners were Brazil with 725 basis points and Russia with 425 basis points. However, we have seen a significant increases also in Latin America and Europe. And in many of those places, the interest rates have moved above the levels that we have seen before the pandemic. And it's expected that those rates will increase further in most cases, and that they will stay on high levels. Generally, the situation of a particular country and central bank and the currency is certainly different. However, there are common arguments in favor of tightening monetary policy by the central banks. One of the key things has been the elevated inflation. And we have seen it all across the world. In many EM countries, we have seen inflation running up also to multi-year or multi-decade highs, with in some countries inflation at double digits already. An example here is Brazil. And there is a number of upside risks to price growth that could materialize and that the central bank needs to guard from. And such risks would be, for instance, a further increase in the commodity prices that we expect. Currently, we have seen Brent futures rising to close to $90 per barrel, and a level of $100, I think, is quite realistic, and an increasing number of analysts also believe so. We have seen a significant upside, significant increases in energy prices, particularly in Europe, energy and gas, and this could further provide some issue for the central banks if this were to continue. Higher energy and gas prices also provide for a complicated environments with regards to food prices, where those costs are also a part of the costs that the customer pays in the store. So there's a number of risks, and also we have this still the pandemic is ongoing. And we are seeing that certain countries, particularly in Asia and particularly China, they have a very serious approach to the pandemic. In our view, it doesn't provide that much of a downside risk to grow, but it does provide some upside risk to inflation. If we were to have a significant lockdown in, let's say, China, then the supply chains disruptions would likely carry on for longer. Risk of de-anchoring inflation expectations is also quite important. The inflation expectations isn't something that we typically focus on. However, it has become quite important, because if the consumer sees that the prices are rising and he expects that the prices are rising, then it can also lead the producer to maybe increase the margins. And we are seeing that in some economies. And the consumer just has to accept that. So the central banks needs to control the inflation expectations to some extent, and generally they have been also stressing that this is an important factor, particularly among the economies that I focus on. This has been the case in the Czech Republic, where the central bank is heavily stressing this issue, but this is also important in other CE countries and in other EMs. The next three are closely related, and they are the currency weakness, the balance of payment imbalances, and the fear of capital flight. Generally, if a currency weakens, we see that it passes on through inflation. The effect varies from economy to economy, but generally we can say that in most EM economies, and it has probably added by around 1 to maybe 3 percentage points. In some cases, it has been much more, as for example, Turkey, where the exchange rate has turned by more than 40% at one point. So this is something that the central banks also need to take into account. The strengthening currency can limit the upside for inflation. If we have a significant balance of payment imbalance, if we see a deterioration in the current account, this can drag the currency down. So again, higher interest rates can shield from that. Fear of capital flight, Yet again, if the central bank is providing the international investors with high interest rates, then they will most likely not leave the country unless there is some serious, let's say, geopolitical or other reason to do so. But generally, the high interest rates have guarded the countries from a capital flight. Another two examples that are closely related to each other is the economy overheating and the tightness of the labor market. This is something that has been particularly the case with Central and Eastern Europe, where we are seeing that some of the economic numbers that we are witnessing are just mind-blowing. We have never seen something like that. For instance, looking at the retail sales and industrial production in Poland, this has been quite extreme. And the labor market situation is practically as if there was no unemployment. In some cases, someone could argue that it's even better than before the pandemic. So this induces a pressure on the core inflation. The domestic inflation pressure is increasing. Therefore, this provides the central banks with a good reason to tighten monetary policy as well. Could we move on to the next slide? And therefore, central banks have been tightening policy, and the market expects them to carry on in 2022. The bulk of tightening is expected to take place in the first half of the year, as you can see on the right-hand side, with in the Latin America, generally what is expected is between something like 200 and 400 basis points of interest rate increases. In Central and Eastern Europe, this is closer to 100 basis points. And then we have some other EM countries where it's slightly different for each other. One notable example here is China. China has been doing the exact opposite and easing monetary policy. And this has been the case for the past few months, but particularly in recent weeks. China has reduced a number of its interest rates, and actually the actions of the country have been quite interesting in that although they are promoting a deleveraging campaign, and they've been doing so for the past few years, they want to shield the economy from slowdown by cutting interest rates, by providing monetary support. And this is one of the reasons why we think that Chinese yuan could underperform a number of other EM currencies in 2022. But overall, our view here is positive. Yes, there's also a number of wild cards, I would say. One is Turkey, who recently have introduced a interesting deposit scheme in which they are basically hedging their citizens from the exchange rate depreciation. The market is pricing in heavy interest rate hikes, although with Turkish central bank, it's extremely hard to say if they will actually follow through with it. The deposit scheme is something that is quite new, and we have to find out whether it will work or not, and this will likely guide the further actions of the central bank. And with China, China's easing policy, there's also Russian central bank, which has been one of the most active in the 2021. There could be a change in the 2022, and the markets are actually expecting that after initial interest rate hikes early in the year, that the central bank will reverse its policy. And this is also a case in some other countries, such as Chile, Brazil, and Czechia. And right now I'll pass on to Matthew.
Yes, thank you very much, Raymond. And what we're going to do is going to briefly touch on something that's been one of the main talking points in markets so far this year, and that's been this aggressive sell-off that we've witnessed in bond markets so far this year. Government bonds have sold off across the board, many major countries in particular, since the beginning of the year, led by the US, as is often the case. We've seen a sharp move lower in US Treasuries, which has sent the yields on these Treasuries sharply higher, given the inverse relationship between the two. Probably two main reasons as to why that is the case. First of which is easing concerns surrounding the Omicron variant, and investors now think that the impact on global growth from Omicron will be relatively mild. So that's leading investors to sell these lower risk assets in favor of the higher risk ones. And also, secondly, and probably most importantly, has been increased expectations for central bank interest rate hikes, not just from the Federal Reserve, but among many of the major central banks. The US, as a leading example, has been a good example of this trend that we're seeing. The entire US Treasury curve has moved up so far this year, and we highlight in particular the 2-year Treasury yield, which is now back above 1% for the first time since February 2020, so just before the COVID-19 pandemic. The 10-year has also risen sharply back up to between 1.85 to 1.9%, which again is also its highest level since January 2020. We're seeing a similar trend in much of Europe and the UK, albeit to a slightly lesser extent. And actually, if we look at the spread between US yields and German yields, for instance, has actually widened still, and is now at its highest level for the 10 years since April 2021. The initial reaction in FX was actually quite a counterintuitive one. We actually saw the US dollar sell off quite sharply in the first 2 weeks of this year, which is counterintuitive given the sharp increase we've seen in US inflation, sharp increase in US yields, and heightened bets in favor of Fed rate hikes, which is usually a positive for the dollar. But we are gradually seeing the traditional trend reassert itself, certainly in the last sort of 3 or 4 trading sessions, whereby higher yields is supportive of a stronger dollar, and the dollar has recovered some of its losses against most of its major peers. But why does the market actually care about this? Well, investors tend not to mind too much when we see large movements in yields over a period of time. Investors do get slightly jittery when we see rapid movements in yields in either direction. Actually, rising yields can be seen as a positive when accompanied by rising inflation expectations. What this does is effectively it's a signal that the market is confident of a strong growth outlook in the future. But the issue that we've seen so far this year is that inflation expectations have actually remained largely stable, certainly in the US, meaning that real rates have actually risen quite sharply. And that does present a bit of a risk to businesses and company profitability, for instance, particularly in sectors such as tech, where profitability is relatively small. We can see tech stocks have fallen quite sharply. The Nasdaq, for instance, is down around about 8% for the year so far. This is not a massive concern just yet. Actually, if we look at stocks, the Nasdaq, for instance, is still trading at relatively elevated levels. So not a big concern for markets just yet, but this is something that investors we very much keep a very close eye on in the next few weeks. Moving on now to the COVID pandemic. And as I mentioned, we think that the pandemic will have less of an impact this year as it has done in the last couple of years, but it's certainly something that the market will continue to keep under a close watch. Particularly Omicron, the spread of Omicron. The market concerns surrounding the Omicron variant has undoubtedly decreased at the sort of end of November, beginning of December. We saw this big sell-off in risk and investors favouring the safe havens on expectations that growth could be set to slow and that restrictions could be brought in en masse. Actually, the news we've had in the last few weeks has been very positive. The booster jab offers very strong protection against serious illness from the strain, in excess of 80%. Symptoms of Omicron clearly are much less severe than previous strains, in particular Delta. And actually, if we look at the hard data itself as well, while we've seen this sharp increase in new cases, we've not seen that translate into new worldwide COVID-related deaths, which remain considerably lower than where they have been over the past 12 months or so, of course. Firstly, because of Omicron, and secondly, because of the effectiveness of the vaccines. So the economic impact actually looks likely to be relatively limited. We did see some restrictions reintroduced in some economic areas over the Christmas period, particularly in Europe. We think this was a slight overreaction, and actually we've seen a lot of these being retraced in the last sort of couple of weeks or so. So our general view is that the return to sort of strict lockdowns will no longer be required. We're positive on the global growth outlook. We think that the pandemic will have limited impact, and that should be good, we think, for risk sentiment. Indeed, we're already seeing a rebound in risk assets. If we look at currency markets, certainly in the G10, we're seeing a bit of a trend. This is a G10 performance tracker from the past 1 month. We're seeing the safe havens largely underperform. The Japanese yen, which is the traditional safe haven in the G10, has been the worst performer in the past month, followed not too far behind by the US dollar, with the Swiss franc around about the middle of the pack. And the higher risk, traditional higher risk currencies like the Norwegian krona, sterling, for instance, are outperforming. We're seeing a similar trend among equities. Equity markets advanced at the end of last year and not too far off record highs. And as we're mentioning, bonds are lower risk. Government bonds have sold off quite sharply as concerns surrounding Omicron continue to ease. I think before I hand back over to Roman, we'll go recap the poll that we sent over. We asked 2 questions, the first of which was, do you think that the European Central Bank will raise interest rates before the end of 2022? We had 206 responses, so thank you everyone for all those responses. And 74% of you said yes. So 74% of you are pretty much in line with our view. 17% no. 9% says too close to call. You may well be right on that one. We'll wait and see. The second one is, what do you think will be the main risk to global economic outlook in 2022? A little bit more divided on this one, but out in front we've got supply chain bottlenecks, 36%, which is very interesting, followed closely by soaring inflation. And as we've been saying, I think COVID will be less and less important this year. Only 12% of you thought that COVID will be the most or the biggest risk to the outlook this year, which is very interesting, sort of confirms the suspicions that we have as well. So thank you everyone.
Thank you. This is very valuable information because there's few people that have their ears to the ground of what's going on in the economy as much as the attendants because of your role in SME companies. So this is very valuable information. Thank you.
Yes, thank you everyone. And with that out of the way, I'll pass back on to Roman, who will quickly go through our final couple of slides before we open the floor to questions.
Thank you, Matthew. So the COVID-19 pandemic is ongoing. It should be less and less of a pain for the global economy. However, we shouldn't be complacent, and this is still a consideration for markets. The Omicron variant, which is on everybody's mind right now, will certainly not be the last that is detected. Others have been reported in recent weeks in France and Cyprus. The important thing for the future is the severity of new variants and the impact on the global economy. Although this impact has been the one that has been less and less important in each of the waves that we have experienced in the developed countries. Looking at the situation going forward, the significant economic disruption is less likely considering the various vaccines have provided to be effective and the vaccination processes are ongoing. The countries are developing the new treatments, which we have not focused on a lot, but this is an important addition in the battle against the virus. And as I said, the economies and businesses have adapted to restrictions. Each wave has been less important from the economic standpoint in the developed countries, and this is likely going to continue going forward and also be the case in the EM countries. Can we move on to the next slide? Yes, we have a positive view regarding the EM currencies going forward as a whole. On the right-hand side, you can see that the EM currencies have performed not really that well, particularly if you look at the JP Morgan EM currency index. The difference in the two indices is largely due to a weighting of the MSCI, which is skewed toward Asian currencies. So this basically confirms that the Chinese yuan and the Asian currencies have largely have performed better than the broad EM spectrum. Nonetheless, we expect both indices and to move up going forward, and the EM currencies to appreciate. The arguments that we think will be important are first the COVID arguments. So the vaccine rollout in the second half of last year has picked up, and this vaccine rollout will continue in the developing world. We hope that this will be the case, but there are all arguments in favor of that thesis. The global growth outlook because of COVID should not, the global growth outlook in the context of COVID should not be negative. As I said, the pandemic has less of an effect, and this should continue to be the case. The key thing is that the EM central banks have raised interest rates to a great extent. They have been very proactive about it, and they will continue raising rates, at least in the first half of 2022, which provides a shield against a depreciation, and which means that even though the main countries will also raise interest rates, the pressure from those hikes on the EMs shouldn't be that significant. We also are expecting a increase in global commodity prices. They're already high, and we think they will be rising. Oil and other commodity prices, they're important for the EMs, where a large number of those countries are commodity exporters, countries such as Brazil, Chile, South Africa, Russia. So this should support them. And looking at the financial situation, the fiscal situation, and overall the macroeconomic fundamentals, lots of the EM countries are quite stable. They are in a better condition than they were a decade or two ago. We see many countries which boast a current account surpluses, and the pandemic has actually helped some countries in that regard. So we think that they should be less prone to sell-offs because of those at least decent fundamentals. There certainly are exceptions to the rule. We are not very optimistic about the Turkish lira, and there are differences in opinion even about some currencies between us. We also, there is a number of risks that we are looking at. There is the slowdown in China, there is the geopolitical tensions that the center of is right now, Russia. So those things can also affect the sentiment and the situation, but overall we remain positive on the EM currencies in 2022. And this will be all. I think we will now move to the questions.
Yes, thank you, Roman. There is a Q&A function in the Zoom app, so if you do have any questions, please feel free to type them in the Q&A section. We'll hopefully have a little bit of time now to get around to answering them. We do, in fact, have one, so we can start off with this one. It's actually on the Polish zloty, so maybe Roman, you can answer this one as our resident zloty expert. And so the question is, the Polish zloty rose a very high rate in the last couple of months. Now it's getting more stable again. But what will rising energy prices and rising inflation do to the zloty in 2022? What are your thoughts on that?
Well, I wouldn't say that it has risen at a very significant rate. It has actually underperformed some other regional currencies, such as the Czech koruna and recently the Hungarian forint. I think the zloty has still some room to go, as the National Bank of Poland will continue raising interest rates, and the pricing in that regard is actually for the most hikes in Poland right now from that point. And the rates are likely going to remain at high levels. So I think that the zloty should be supported in large part because of that. If we are not going to see a deterioration in the relationship with the European Union, if we are not going to see a significant deterioration in geopolitical sentiment, I think there is every reason for the zloty to strengthen going forward and to return close to the level, perhaps maybe for the euro zloty slightly above those we have seen before the pandemic. But I think that it still has some course to run.
Great. We have another question on our take on emerging market FX. Given aggressive US rate hikes, do we see a flight to safety versus carry trade. I think Roman covered this in part in one of his last slides, but I think we generally between us very bullish on emerging markets. I think there's a lot of supportive factors to suggest that they're better equipped to weather this process of policy normalization from the Fed than they have been in the past. My point, what I would like to stress, is that if we look at most emerging market countries and economies now, they're much better equipped financially to deal with them, whether that be they've accumulated large levels of FX reserves or positive current account surpluses. I think that should support these emerging markets, and I think between us, I think we're all pretty bullish on EMs.
I mean, that's something that is different this time is how slow to raise rates G10 countries, not just G10 countries in general, have been, much slower than the previous cycles, whereas emerging markets have been, if anything, quicker to react to inflation. So that's, I think, partly explains why we've seen this strong performance in emerging markets so far this year, even on the face of higher US yields, in that the emerging market central banks had, so to speak, already done their homework in 2021 in raising rates to ward off inflation, whereas the G10 countries are now catching up. There is a risk that a disorderly sell-off in the treasury market in the US would cause a temporary flight to safety. But even in that case, I think that most major emerging market countries are less exposed to sudden stop in financial flows because they have done a good job of replacing hard currency debts for local currency debts. So they're much less dependent on flows from the first world to finance their current accounts. So that also explains why we're so bullish in emerging markets in 2022.
We have a question on commodity prices as well. Are high commodity prices expected to continue to rise beyond 2022? What do you guys think about commodity prices? Do you have a strong view necessarily?
I think it strongly depends on the analyst. Generally, forecasting commodities is extremely hard for everyone, and the forecasts are typically made in a very short, for the very short time. However, if we assume that the demand for energy will continue to increase, if we assume that the transition to maybe a slightly more green world should follow, then considering that the investments in the refineries and also energy productions, etc., are not going to be very feasible and very cost effective for many companies, I think that they should continue going up.
I think here there's a new term that I've seen introduced, especially in Europe, called greenflation, in the sense that we're finally realizing that all these greening regulations, these restrictions on mining, these climate change related restrictions on fossil fuels, consumption, exploration, carbon taxes, etc. In the end, what they add is to inflationary pressure, in particular in the commodity sector, which I think is going to be a very important factor driving commodity prices upwards over the next few years.
Yeah, and if we look at the soft commodities, for instance, the food commodities, we also have another effect, which is, I would say, probably climate change right now, or at least the effects of extreme weather events. And this has been the case with the coffee prices in 2021, which have skyrocketed. But this can also mean that we are going to see elevated food prices going forward. If the energy prices will continue to go up, this is even more of a case.
Great. We also have a question on sterling euro, which perhaps maybe I can answer. The question is: there seems to be much resistance at 120 for sterling against the euro. What's our views midterm? I think actually for sterling euro we've turned slightly neutral on that pair in the last couple of months or so. On the one hand, we're quite bullish on sterling because we think that the Bank of England is set to raise interest rates pretty aggressively this year. Expect a hike in February and total of 4 this year. The UK economy, we think, should remain pretty resilient. Virus restrictions have been very, very limited. The booster program has been going well. But on the other hand, actually, we look at Europe, we think that, as we've been mentioning, we think the ECB is, or the market is massively underestimating ECB, the chances of ECB interest rate hikes this year. Once the ECB, we think, starts to catch up with the rest of the G10, including the Bank of England, that's when we think we might start seeing a bit more of a sustained rally in the euro. So we could start seeing a bit more sterling strength against the euro in the short term, but we think as we get towards the second half of this year, that's when we might start seeing that bit more of a rebound in the euro.
Yeah, so I'll also reply to the question about the projection for the euro zloty. We have the 4.30 euro zloty rate at the year end, and the reasoning for that is a positive view on the EM currencies, a positive view regarding the sentiment towards Europe, towards COVID, and towards the EMs. Also, monetary policy tightening. As I said, this is likely going to continue to be quite aggressive. And generally, we think that the relationship with the European Union should not deteriorate further. In fact, we expect that the money that Poland is expected to receive should flow to the country. The new funds that have not been pre-financed in the previous year.
Okay, great. We have another question. Over the last week, we've seen a strong appreciation of the US dollar and an increase in the prices of Chinese transport and goods. What is your expectation of the US dollar exchange rate? And do you think the price of Chinese goods indexed to the cost of transport by sea will continue to increase? Does anyone want to take that question?
Matthew, why don't you take that? I don't really, I will answer the second part. We don't really have a strong view on a sector by sector or country by country pricing. We think that there's generally inflationary pressures are here to stay. There's a number of factors driving a medium and long-term inflation higher. The prices of Chinese transport and goods right now, I think, are much more dependent on individual bottlenecks, which are driving increases of 50 and 100%, than moves in the dollar-euro exchange rate, which are much, I think, of a second order. Our expectation of the dollar exchange, Matthew, you can go into more detail, but it's that we think that the dollar is done rallying for now over the medium term. That there's so much priced there's so many Fed hikes priced into the market versus almost none in the European Central Bank in the whole year of 2022, that is going to be difficult for reality to outperform that expectation. And the current level of the dollar has priced in a massive gap between Fed rates and European Central Bank rates by the end of the year that may not materialize as large as the market expects.
Yeah, I think that sort of leads into our next question, which is on euro dollar. It says, do you think that US dollar euro is overpriced, the euro dollar underpriced effectively? And I think, yeah, as you mentioned, Enrique, I think our view that the market is underestimating the ECB, the fact that the Fed bets in favor of the Fed hikes is perhaps, we think, are oversaturated. That does present some room for a move higher in euro dollar, which we think is slightly undervalued at current levels. We've got a few more. Perhaps we'll just answer these last couple of ones quickly and then wrap things up. We have one. Do we think the eventual more aggressive move of ECB rates could cause problem in peripheral spreads and ultimately weigh on Europe growth or European growth? What do you guys think? Do we think higher European rates could weigh on European growth?
My personal view is that rates are so low in the Eurozone. Let's not forget they're negative. Well, not only the rates, the European Central Bank overnight rates, but also the rates paid by sovereigns and even corporations and consumers are so low and so far below inflation that we're very far from the point where higher rates would be a serious problem for European household sovereigns or corporations. So no, I think that right now, for at least the short and medium term, the European economy is, in general, is very resilient to higher rates from the ECB. It's my view.
No, that sounds good. We have another one on what about the CNY versus the US dollar? What do we think of this trend? I think generally for CNY, we have been pretty bullish on the yuan, certainly the last sort of 6 to 12 months or so. And actually, that view has been vindicated by this resilience that we've seen in the Chinese yuan, which we think is sort of more transitioning into a major currency as opposed to an emerging market one. I think that view now is more of a balanced one, because on the one hand, CNY is becoming more increasingly used in global FX transactions for global trade. That's a positive for the yuan. But actually, at the moment, what we're seeing is authorities in China are doing the opposite from pretty much every other central bank in the world, and easing policy, cutting some of their interest rates. We're seeing downside surprises in Chinese inflation. So that does present somewhat of a downside risk. So I think on the whole, we have a relatively balanced view on CNY against the dollar. Maybe we'll just ask this one last question. It's on US dollar CAD. So what's our view on the Canadian dollar? Again, I think similarly to CNY, I think we're relatively neutral on this pair. Slightly more bullish on the Canadian dollar. Bank of Canada looks set to raise interest rates very aggressively this year, more so than pretty much every other G10 central bank. But similarly to the Fed, actually, a lot of that is already priced in. In fact, the market, as far as the Bank of Canada is concerned, I think maybe getting slightly carried away with itself. I think it's, as of the last couple of days, been pricing in 5 or 6 or more hikes from the Bank of Canada this year. That seems a bit excessive. So while there could be a little bit of upside in the Canadian dollar against the US dollar, I think it could be quite limited.
I'm a little more bullish on the Canadian dollar, mostly because of our view that commodity prices have the wind at their backs. The Canadian economy is probably one of the G10 economies most exposed to commodity prices, with the Norwegian kroner, and I think that's going to the Bank of Canada will welcome currency strength as a way to manage inflationary pressures within Canada. But it is true that a lot is priced in already after this significant rally that was on the Canadian dollar in 2021.
Okay, great. I think that's all the questions answered. We went over a little bit, but yeah, that's great. Thank you, everyone, very much.
Thank you. Thank you very much.
Really appreciate it. And we'll send out communications for our next global webinar, which, as we tend to do, we'll try and do on a sort of quarterly basis or so. But thank you, everyone.
Bye.
Bye.